It is an honor to be here and an honor to introduce our two panelists for this first session this morning. We are actually, I think, going to sit in a relatively docile fashion behind the table here, but I just wanted to take a moment to set the stage in inviting our two panelists up. And I do want to say that these are two individuals who, in some sense, need no introduction. They have outsized reputations and profiles in the financial world, but really, to Peter's point, as the financial world or the world of Wall Street has begun to become such a major news item for all of us in the broader business world, they're both very well known to anyone who spends any time consuming media or content or information relating to financial news. Our first panelist, and let me introduce them and then invite them both up here, is Jeremy Siegel, who is the Russell Palmer Professor of Finance at Wharton. I wanted to make sure that I got your benefactor correct, Jeremy, just to make sure we had the formalities out of the way. Many of you will know him from his appearances on CNN, CNBC, NPR. He writes for Kiplinger's personal finance newsletter. He also writes, and I think this is very ecumenical of you, for Yahoo Finance. So from one end of the spectrum to the other, from the elite to the great unwashed. Very kind of Jeremy to do that. He's also an advisor to Wisdom Tree Investments, as many of you may know. But maybe most importantly, aside from his illustrious academic career at Wharton, he is the author of books that many of you will know. One is called The Future for Investors, but the classic, Jeremy, if I may say this, is Stocks for the Long Run. This has been described as the most complete and irrefutable case for stock market investment ever written. Some people have named it one of the top 10 books ever written in the business field. It's easily a giant in the business and financial sectors. It's in its fourth edition and continues to be an extraordinary case for the fact that actually investing in these things called equities in the long run, according to Jeremy's statistics, over 200 years of carefully processed data at Wharton gives us, a 7% annual return, and no reason to think that in the intermediate to the longer term that should not continue. For that reason, you will know that we are identifying, at least for the purposes of this morning, Professor Siegel as our bullish member of the panel. Maybe I'm stating the obvious, since he is known widely as the Wizard of Wall Street. I love that, and the Wizard of Wall Street from Wharton, so it's a triple alliteration if you add his academic affiliation. So we're thrilled to have Jeremy here. We also have the bear in the room, and that is none other than Peter Schiff, who is equally well known. I noticed that the news outlets have some overlap but some divergence. So CNBC, Fox News, and Bloomberg TV. So that must already tell you something about his leanings. I think many of you will know Peter as the single individual who is credited widely for having predicted in his book Crash Proof in 2007 the financial meltdown that has afflicted all of us over the last couple of years and put finance at the center of business news. Crash Proof is available now as Crash Proof 2.0, which is the original text of the book with then Peter's commentary, which I think is mostly Peter to indicate that he was right. Because after all, a couple of years later, I enjoyed the commentary a great deal, but of course it was essentially attributing much of the insight that he has brought to his business. He is president and chief global strategist of Euro-Pacific Capital, which is a broker-dealer based in Westport, Connecticut. So Peter has been a very successful practitioner in financial services, obviously a highly influential author and media figure, and one who believes that tangible assets are great, but equities and dollar-denominated assets are not so great, and that we face a future of an appreciating dollar. And, let's just say that we have the Wizard of Wall Street, and on the other hand, a man who is widely known as Dr. Doom in the room. And so I simply wanted to say that just to prepare us for the debate that is about to come, I was thinking back to the economic crash, if that's what it was, the market crash in October of 1987, and remembering that the very next day there were wonderful jokes that emanated from Wall Street, which was after the morning after that crash. Jeremy, Peter, and I are all old enough, I think, maybe Peter isn't, to remember this, but the joke was, what do you call an investment banker? And the answer was, waiter. And that was morning after the crash. My particular favorite was, what's the difference between an investment banker and a pigeon? And the answer was, a pigeon can still make a deposit on a Mercedes. And so I just wanted to put things in perspective, because almost 25 years later, wow, there were buying opportunities 3 days after that crash, and very much supporting Jeremy's proposition that, these are short-term corrections that create opportunities to participate in long-term wealth creation. The last couple years has made what happened in October 1987 seem like a drop in the bucket, and that's what we need to talk about today. So I want to welcome very warmly Jeremy Siegel and Peter Schiff. Gentlemen, please join me, if you will, at the front of the room. Thank you so much. Peter, welcome. So as I said, we're going to, Jeremy, sorry if I grab this seat. We'll put you right in the center and Peter over at the end here. And we thought we would begin, and I do want to say, just in the spirit of what Peter said to start us off, we'll at halfway through this session make sure that all of you get a chance to talk with these two esteemed gentlemen. But first, we figured it was only fair to let them lay out their visions for the future. I know we're all anxious to hear that. Both of them have crystal balls, I think of different hues perhaps, but crystal balls nonetheless, in which they have a great deal of confidence. And we have agreed, as a matter of, I believe, a coin toss on a conference call several weeks ago, that Jeremy would actually take the first shot. And Jeremy, so I welcome you to do it either from the table or up at the podium, whichever is more comfortable.
What do you want?
That's up to you.
Yeah, I'll go up there.
All right. Then please let me welcome you to the podium, and make sure you have proper amplification.
Thank you.
So, Jeremy.
All right. They gave us about 10 minutes up here, so I want to hit a couple of points that I think are important, and I know a lot of others points will fill up as we go into the more detailed discussion. I'm going to talk a little bit about future growth, and then I want to talk about our stock market. How is it valued? Is it cheap anymore? Is it fairly priced? Is it overpriced? And how do we judge it? Okay, on number one. Now, we hear about slow growth. We hear about the new normal, Bill Gross and PIMCO, that, we're going to have 1.5%, 2% growth going forward. I don't believe that. And I'll tell you why I don't believe that. My academic background is actually in economics. I got my PhD from MIT. I was honored enough to be able to be taught by some of the greatest economists, Paul Samuelson, Robert Solow, and others. And when I was going through the PhD program, 1960s, the hottest topic was productivity growth and long-term economic growth. Because economists discovered that when you look towards the long run, you should not use those Keynesian ideas of consumption, investment, government spending, CIG, as all of you have learned, as determining GDP. That's fine in the short run. That's fine over the business cycle. It is not appropriate when you're looking ahead 5 years, 10 years, or more. What is appropriate for understanding the sources of growth when you look forward a good length of time? Unquestionably, it was productivity growth. The growth of productivity, which is really defined as the output per man hour or woman hour or person hour. How much more do we produce over time because we learn how to do things better? We learn to produce more with less. That has been the driving force of the increase of our standard of living over the last 200 years. I look at a lot of long-term variables, as Jeff mentioned, going back to stock market, back to the 19th century. And I've looked over many macro variables, and they don't look so good. GDP growth and consumption growth and a lot of other things. But one variable stands out as not only holding its own, but actually increasing over the last 5 years. And that is productivity growth. It has been astounding over this business cycle. A year ago, for the first time in over 3 decades, we had 3 consecutive quarters of year-over-year productivity growth that exceeded 6% per year. By the way, the long-run productivity growth in the United States and most developed countries is around 2%, or slightly above 2% a year. Now you say, Jeremy, okay, I get that, but what makes you optimistic about productivity growth? Do you know what the source of productivity growth is? Discoveries, inventions, innovations, the ability to do more with less. And as someone who has been in the academic realm for the last, 40 years almost, I've seen a revolution in the ability to do research, to collaborate with others, that is absolutely astounding. You know, I was reading The Economist just a couple weeks ago. They brought up something that was really very interesting. 15 years ago, 90% of the scientific articles that were in the learned journals were written by those from North America, from Europe, or Japan. Now it is down to 75%, just in the last 15 years. What has happened? We have brought China online, we have brought India online, not just in terms of their emerging economies, but in terms of their potential intellectual outlook in contributing to productivity. How to do things better. I have colleagues now at Wharton that can more easily collaborate with an economist in Shanghai on a paper than when I, 30 years ago, started academics, could collaborate with my colleague across the hall on a paper. That is astounding. And what is astounding is, you know, Japan, United States, and Europe is what? 12 to 15% of the population. Now we got between India and China and hopefully others, an extra 2 to 3 billion people brought in line that can do research and improve our standard of living. Let me just finish with one thought. A lot of people say, Jeremy, that sounds really good. It sounds good for them. They're going to be the ones that are going to discover. One thing we know about productivity growth, it benefits everyone. Certainly the person who invents it is going to get rewards from it, patents, copyrights, or whatever. But the benefits flow to everyone. The discoveries flow to everyone. Discoveries in terms of medical science and curing cancer, conservation, alternative energies, alternative energy sources. But we can go on and on. That's the driving force of the improvement of a lot of mankind and employment going forward. I see that upward trend in productivity continuing, not accelerating. And that's what makes me so bullish about the future. Now, let me talk a little bit about the markets and valuations as we see today. A lot of people say to me, Jeremy, hey, come on, markets pretty much on average valued. You know, I see 15 is the average PE ratio of the S&P 500. We've seen that over the last, 100 years, 30 years, 50 years. We're a little below that, but not much. Let me give you some really interesting data because I look at earnings all the time and follow them very carefully. Listen, what fundamentally we talk about valuation of stocks, there's 2 ingredients: earnings and the interest rate that you discount those earnings at. I want to talk about earnings. Current estimate for 2011 earnings on the S&P 500 is $94.44. Now, we're at the level, and I've updated till last night with that nice rally that we had yesterday, 12.7 price earnings ratio. All right? So that's already about 20% below the long run average. In other words, if we were at the long run average valuation, it would be 15, we would be at 1,417 rather than 1,200 on the S&P 500. But let me give you something that surprises most people. That 94.44, which actually has been rising over time over the last 6 months on what it is. Do you know what the all-time high earnings on the S&P 500 was? In the 12 months ending June of 2007, $91.47. Now, we can talk about unemployment, we can talk about a million variables that are lagging behind horribly from past recessions. But there is one variable that has blown every comparison out of the water. In fact, people say, I've never seen anything like it before. And what is that? The rebound in earnings has been unmatched in any recession in history. I'm an optimist. And if you would have asked me 2 years ago, Dr. Siegel, going through the worst economic downturn since the Great Depression, do you think 2 years later you would see S&P have record all-time earnings? I say that, no, listen, I'm an optimist, but that's not going to happen. Okay, that is the current forecast. By the way, again, a forecast that keeps on going up and up and up, month after month. Even the pessimists say, listen, I can't deny the earnings are now out. How high they've actually come. Number two, and then I'm going to sit down and give Peter a chance. I said there's two factors when you're talking about stock prices. One is the earnings, and the other is what rate you discount those earnings at, the interest rate. This is the really astounding thing. People ask me, Jeremy, have you ever seen market cheaper? You say it's 12 times earnings, 12 and a half. Oh, yes, I've seen it cheaper. When have you seen it cheaper? Oh, in the 1970s and 1980s. When was it then? Single digits. Well, Jeremy, isn't there a good chance we can get back down there again? We had the worst recession. We're not going back down there again. Oh, why not? Why are we not going back down there again? For one simple reason. Back in the 70s and early 80s, every one of you and us, an investor, could have yanked his money out of the stock market and put it with long-term treasury bonds at a guaranteed yield of 16.5% per year for 10 years. That was your alternative. That made it tough for stocks. The only time actually in history that you're going to have any prolonged period of single-digit PE ratios is when you have double-digit interest rates. Double-digit interest rates. I ask you today, what are your alternatives to stocks? 0 on the short-term yield, 2.5 to 3 on the 10-year yield. Let me put it this way. The last time we have ever seen stocks as cheap as they are now relative to interest rates was the late 40s and early 1950s, when, again, everyone said we're going to have another depression, wrongly predicting what was going to happen after World War II. What did we set ourselves up to? We set ourselves up to, in the 50s and early 60s, the greatest bull market that we ever knew until the 80s again. And by the way, as a warning, the worst bond market in the next 20 years. This climate reminds me of the early 50s, when stocks were really cheap, yields were very good on stocks, and no one wanted them. They all wanted to run to their treasury bonds. And we know what happened. I wrote an article, it was appeared in August in the Wall Street Journal, called The Great American Bond Bubble. I say this is going to burst. I think it has burst. I think we have seen the low of the yields. I think the yields are going up from now. And I say that, when you're thinking about where you're going to get for yields, more and more people are going to say, you know what? I like stocks that are giving good dividends, that are well covered with their earnings. Now, Peter's going to talk about the inflation, what we're going to get. Let me end on this thought. Actually, do you know what the sweetest spot for stock market is in terms of inflation? 3 to 4% a year. Not this current really low level. And not double digit either. And that's definitely going to give the market trouble if you think we're headed there, which I don't, and we can debate that later. It's actually 3 to 4% per year. If you go back through history, is the sweet part for stocks. I think that's exactly where our Federal Reserve is wanting us to be, a little above 2. Bernanke won't admit how much above 2, but he wants it a point and a half above 2. And believe it or not, through history, that's a sweet spot for stocks and their valuation. I think the next 3-4 years are going to be absolutely superb returns for investors In equities, I think they're going to be very dangerous times for bondholders, and I guess we'll discuss how commodity holders are going to do in the future. Thank you.
Jeremy, thank you very much. Okay, so I think we have all reason to feel very, very good right now. And Peter, before you stand up, or now you're standing, I mean, all right, so brace yourselves. Now we're gonna hear the other side of the argument. And by the way, I should have mentioned there's a wonderful book in the back of the room that Peter's just published in 2010, Why an Economy Grows and Why it Crashes, and it actually is illustrated.
Yeah,
with New Yorker-style cartoons. It's a marvelous thing.
Yeah, well, I wrote it so that even a grade school kid would understand the economic crisis. And the reason I did that, I wanted to make sure that members of Congress could understand it. So hopefully they'll read the book. But anyway, yeah, let me first paint a picture of where we are as an economy before you figure out, how to make investment advice or how to make recommendations to clients that you're consulting with. The U.S. economy is, in fact, a house of cards, and it's only a matter of time before it completely implodes, and it's not a long time. And we're not talking decades. We're talking just a few short years. The problem with our economy is that it is really screwed up based on government intervention and manipulation. The government, through the Federal Reserve, has kept interest rates far too low for too long. In addition, the government has distorted economic decision-making through a number of ways: guaranteed bank deposits, guaranteed mortgages, guaranteed student loans, subsidies to various industries, in particular healthcare. As a result, our economy has evolved on a very dangerous and unsustainable tangent where collectively Americans just spend much too much money, but they don't produce enough stuff. We borrow much too much, mainly to finance consumption and government spending, but we don't save enough, and we don't have the savings to finance capital investment. Too much of our economy is in the service sector. Too much of our GDP is in finance, in healthcare and education, and not enough of it is in manufacturing and goods production. As a result, we have massive external imbalances. We borrow tremendous amounts of money from the rest of the world so that we can consume the goods that our inefficient economy no longer produces. And we borrow all this money. And the result of this has been asset bubble after asset bubble. The stock market bubble during the 1990s, the real estate bubble that followed during this decade, were creatures of government. They were creatures of government policy. They never would have evolved in a free market where market forces would have reined in these excesses. Government did it. And when the stock market or the real estate bubble collapsed in 2008, pretty much the way I said it would, and I have my book out there, Crash Proof 2.0, and you can read what I wrote. Most of Crash Proof was written in 2005. I finished it by mid-2006. So when I was writing it at the peak of the bubble, when nobody even thought there was one. By the time it came out in early 2007, people were beginning to get a little nervous, but they still didn't realize how bad it was going to be. I realized it years in advance. But when that bubble burst, and all of the financial entities that financed it, Freddie and Fannie, many of our major investment banks and commercial banks, were on the verge of bankruptcy and failure, rather than letting the market work, we embarked on the most irresponsible and reckless combination of monetary and fiscal policy in U.S. history, which was very difficult because prior to that, we had the most reckless and irresponsible monetary and fiscal policy under Greenspan and Bush. And then Greenspan and Bernanke, and now Obama and Bernanke managed to outdo that, and which is a feat that was very, very difficult to accomplish. And so the result was not that the government saved the economy with the bailouts and the stimulus. Far from it. All they did is dig us into a deeper hole. They guaranteed that the financial crisis in our future is far worse than the one in our past from 2008. So we didn't solve anything. We delayed and exacerbated. And the crisis that we're coming to is not just going to be a financial crisis. It's going to be a sovereign debt crisis. It's going to be a currency crisis, a dollar crisis. And the impact of this crisis on the economy, on the standard of living of the average American is going to be far more severe than what we had in 2008. You know, if you look around at the world and you start to see the sovereign debt crisis going from nation to nation, right? It started out in Iceland, was the first nation to experience this. Then all of a sudden it was Greece. Then it was Ireland. Now we're looking at Portugal. And our leaders have a very familiar refrain that this subprime problem is contained, right? Or this sovereign debt crisis is contained. It's contained to these few pig countries in Europe, so we don't have to worry about it spreading beyond those few countries. Well, that's absurd. This is exactly what they were saying when we first started to see the mortgage problem in the subprime market. The experts were telling us, don't worry, it's contained. It's just in the subprime. Now, at the same time, I was on national television saying, no, it's not subprime. It's a mortgage problem. The problem permeates the entire mortgage market. It's just that we're seeing the problems first in subprime because those are the weakest links. So, it wasn't a question of the contagion spreading. I said everybody is already affected. It's just you're seeing it in subprime first. You will see it in prime mortgages later. And, of course, that's exactly what happened. That is what we're seeing right now. We are working our way up the food chain of sovereign credit. And the reason that all of a sudden Ireland is having a problem with its debt, or Portugal is having a problem with its debt, these are the same debts they had last year, right? The thing that's changed is that interest rates went up. So the debt was manageable last year when rates were low. It is not manageable now that rates are higher. The same situation awaits the United States. Jeremy mentioned that interest rates are now rising in the United States, and they are. In fact, the yield on the 10-year now is above 3% and rising. It's actually rising a little bit more rapidly over the last couple of weeks. The yields on the 30-year are rising as well. I think we're about 4.2, 4.3. We're still low, but we're not going to stay there. And when interest rates really begin to rise, that is when we are going to be on the verge of a real crisis, because now the Federal Reserve is going to be staring at a choice that it does not want to make, right? It's going to have two options. It's going to have to aggressively raise interest rates, which it should have done a long time ago, and contract its balance sheet by selling mortgage-backed securities, selling treasuries into the market and tightening, right, and defending the dollar and fighting inflation and doing what it should have done a long time ago. But if it does this, it will bankrupt every major financial entity in this country. The reason I think that the S&P earnings have risen the way Jeremy pointed out is because a couple of years ago, all the banks were losing billions. Now they're making billions because money is cheap again from the Fed. Banks are making a fortune borrowing for next to nothing and then loaning back to the Treasury or loaning into the mortgage market, and they're making these huge spreads. Well, what happens when the cost of borrowing goes up? What happens when the Fed funds rate isn't 0, but 5 or 6 or 7%? And the banks are earning 4%, 5% on their investments because they own treasuries, they own mortgages. They're all going to fail. And the size of the losses will be larger than what the losses were in 2008, which means the government is going to have to let fail all the banks that had already bailed out. But what about the federal government? What's going to happen to the federal government? Right now, the only reason the federal government can service the national debt, which is now about $14 trillion. And, of course, I'm talking about the tip of the iceberg. I'm not talking about unfunded liabilities. I'm not even talking about the $6 or $7 trillion that Fannie and Freddie owe that is now a government liability. I'm just talking about the $14 trillion in Treasury bonds. Well, the reason that we're able to service the debt is because interest rates are extremely low. The average maturity on the national debt is just a couple of years. I think the average rate at which the national debt is financed is under 2%. I think the government's paying about 1.5% interest on the national debt. Now, what happens when the Fed is forced to raise interest rates to 5% or 6% or 7%? What happens to the cost of servicing that debt? It goes through the roof. All of a sudden, maybe the federal government is going to have a $1 trillion a year expenditure just on interest on the national debt. A significant portion of that going to China, going to Saudi Arabia, going to Japan. It's not being recirculated to other Americans. It's going to be a huge drain on our national income. And, of course, where is the U.S. economy going to be if the Fed funds rate is 5 or 6 or 7%? Well, back in recession, where's the housing market going to be? Even lower, right? Stock market lower, more unemployment. So what's going to happen to the federal deficit? It's going to get even worse, which means the government's going to have to borrow even more money at a time when the cost of borrowing is rising even higher. So this is going to be a major, major collapse. And you can think about it's the same way that we have in the mortgage market. When people were buying houses they couldn't afford with teaser rates on their adjustable rate mortgages, the problem didn't hit until those mortgages started to reset and the teaser rates went away. Well, you can think of the same thing with the U.S. government. It's got a teaser rate on an adjustable rate mortgage, which is the national debt. Do we have a national debt that's financed with 30-year government bonds fixed at these low rates now of 4%, 4.5%? No. Our leaders weren't smart enough to do that. They decided to opt for the cheap fix and take an adjustable rate mortgage because in the short run, they can pretend they can service the debt. But once the rates go up, our debt is just as unserviceable as Ireland's, as Greece's, as Portugal's. There is no difference. In fact, I think the problems are worse here. So the choice that the Federal Reserve is going to have is going to be raise interest rates, defend the dollar, stop inflation from running out of control, and let the chips fall where they may. Force the federal government to make draconian cuts in federal spending. Huge cuts right now. Make cuts to current recipients of Social Security. You're going to get a smaller check than the check you're getting now. Reduce the pay, not freeze the pay, but significantly reduce the pay of government employees. And most likely restructure the national debt, meaning that holders of U.S. Treasuries are going to get less than 100 cents on the dollar. These are the reforms that will have to happen if the Fed raises interest rates to protect the dollar and stop a run on the dollar. Alternatively, if the Fed decides that they can't do that they cannot do that politically, they cannot force big cuts in government spending, they cannot force all this, they cannot allow banks to fail, then the Fed is going to continue to monetize. It's not going to be QE2, it'll be QE3, it'll be QE4, QE5. And when that happens, when the markets sense that this is what we are doing, that's when it's not just inflation, but runaway inflation or hyperinflation, and interest rates will start to rise dramatically, not just on Treasury bonds, but on corporate bonds, on municipal bonds. And of course, I forgot to mention that one of the things that's going to happen if the Fed does the right thing and raises interest rates is many state bonds will go into default. Many municipal bonds will be defaulted because the only reason that the states are able to make their payments is because rates are low. When rates rises, many of our states will be failing. And so in the first scenario, the Federal Reserve lets the states fail. In the second scenario, we bail them out, right? We don't let California default. The Treasury buys California paper to bail them out. And so the Fed doesn't become the buyer of last resort. It's the buyer of only resort. The Federal Reserve will be the only buyer of any U.S. dollar-denominated debt issued by anybody. Because once people start to realize that inflation is 5%, 10%, 20% a year, a month, whatever it's going to be, nobody is going to want to lend money to anybody to be repaid in dollars. And so the only entity willing to loan will be the Federal Reserve because they just create the money. They don't care how much purchasing power it loses. So, and if we go down that route, which of course is the politically more expedient route, then it's a complete collapse. I mean, then you're looking at runaway inflation, potentially price controls, which will not work, which will produce shortages, rationing, black markets, civil unrest, rioting, much worse than what we see taking place in places like Greece. You're laughing, but this is what we're staring at. So how does this impact your investment decisions? What do you do with your money? I agree with Jeremy on one thing. You don't want to own bonds. You do want to own stocks. I don't believe you want to own stocks here in America. I think U.S. stocks are going to lose a lot of value because of what's going to be happening to this economy and how it's going to be further undermined by the government. I'm worried about punitive taxes being imposed on American companies that manage to make a profit. If you are going to invest in U.S. stocks, stay away from any stocks in the U.S. that are geared toward the domestic economy. You don't want to be in the financials. You don't want to be in retail. You don't want to be in home building. You want to be in multinationals. You want to be in natural resources. You want to be in exporters. That's where you want to be. You want to be in stocks that can pay you a dividend, especially if their earnings are coming from abroad. But you're much better off avoiding the U.S. entirely, owning equities in Asia, in other parts of the world, owning equities in countries that have better balance of trade, that have lots of natural resources, where their terms of trade will improve as commodity prices rise. I think commodity prices will continue to rise rather dramatically, particularly if you're paying for them in dollars. Precious metals, I mean, gold right now is around $1,400 an ounce. I think it's still very, very cheap in terms of dollars. I do not believe that the U.S. stock market will collapse in terms of dollars because they will simply print too many of them, but it will collapse in terms of gold. The Dow was worth 43 ounces of gold in 2000. Today it's only worth around 8 or 9. By the time this bear market comes to an end, it'll be worth closer to 1. So that's where you get a real collapse in U.S. stock prices. Relative to real money, relative to something that is not being created. And, as far as the U.S. economy, we're not really getting out of the recession. We're not getting out of it at all. In order to get out of the recession, we would have to have a legitimate restructuring of our economy. We would have to allow labor and capital to be reallocated more efficiently. People would have to lose their jobs in the service sector, in healthcare, education, and migrate into goods production, manufacturing. We'd have to have much, much higher interest rates so that we can encourage savings in this country, because real capital investment, real economic growth is a function of savings, which finances capital investment. All this would have to happen. We'd have to have a painful restructuring of our economy, a shrinking in the size of our government relative to the wealth-producing part of our economy. None of this is happening. All we are doing with our current policy is repeating the very mistakes that led to the crisis, because nobody in Washington has the guts to level with the American public, to let them know the extent of the problems and what really needs to be done to solve them. They would rather find ways to put Band-Aids on the cancer so nobody notices that it's getting worse, and eventually it's too late and the patient dies. And unfortunately, in this case, the patient is the U.S. economy. Thanks.
Okay, so any of you who did not eat breakfast earlier are not likely to eat breakfast right now. So I'm glad that there was some nourishment early in the day. Let me start with the obvious, if I may turn to our two panelists, which is to say Jeremy is telling us that we're on the verge of recovery and possibly a rally in the stock market akin to what happened in the late 40s, early 1950s. And Peter's telling us that actually there is no recovery from a recession at all. It's actually only the beginning of an even deeper crisis. Jeremy?
Yeah. Oh, wow. Well, where should I start? Okay. Let me say on a couple of topics, and then we'll get on some of the others. First of all, I share Peter's enthusiasm about the emerging markets. I've always been strong on those. China, India, and you can add several others there. I think that they are going to be, they already are leading the economy. Almost every one of those are already above the pre-crisis peak in terms of GDP. I continue to believe that they're going to grow faster, and I'm very enthusiastic there. Honestly, though, if we talk about the developed markets of the economy, I'm most positive on the United States. I think the euro is a mess. I think we have not seen the end of the problems of the euro. I think the fact that these peripheral countries abandon their own currency is going to be like a straitjacket. It's going to be very difficult for them to do what they did classically as a country that was in those sort of cost problems. They devalue and then become competitive again. And, there's an adjustment that has to be done. It is done. And that happens. It cannot be done, as we know, once you abandon your currency. So as long as the ECB remains relatively firm. You're going to have tremendous weakness on the peripherals in terms of Spain, Portugal, Greece, Ireland. Finally, that weakness on the peripherals will impact the interior, Germany and the hard euro, and they're going to have to start easing and depreciating relative to the dollar. We've seen it go from about 143 down to 130 in a few weeks. I think I can see it going all the way back down to $1 over the next 6 months or a year. And then, if you really want to talk about a country that I think does not have good prospects at all, Peter didn't mention Japan. What's interesting is that in many ways, I want to hear what he has to say about that. In many ways, what one could say about the United States could be said in spades about Japan, in terms of its debt to GDP ratio being twice as big as the United States, highest among all the countries in the world, and yet no inflation, in fact deflation, in fact stronger currency instead of weaker currency. And none of those scenarios, even though they've been following a more fiscally profligate path than the United States. So, what is going on there? I think eventually that will turn. I think Japan's problems are structural. I don't think they're amenable to the type of technological change and disruptive technologies and innovation that keeps a country growing and young, the way I think we are. And I think eventually the yen is going to sink relative to the dollar and go up. So I think relative to the developed countries in the world, both Japan and Europe, I think the dollar is going to be stronger. I think the dollar is going to be weaker relative to developing countries. I think they're going to be strong, but I don't think we're going to get the type of massive depreciation that Peter sees. Again, let me just say, actually, I agree with Peter that the government should be floating more long-term bonds at the better interest rates rather than the short term. But two-thirds of the deficit is due to the recession. Once the recession ends, which I fully expect it by the middle of next year. In fact, I think we're really going to begin to see the growth of private employment over the next 6 months. The outside of the interest payments, and they will rise as interest rates go up, but outside of that, we'll have a two-thirds reduction of about $500 billion. That is barely feasible. Our big long-run problem is Medicare. If you look 5% of GDP, that blows up the budget. We're going to have to do something about it, and the Obama health plan does nothing about that. So that's that and other entitlements, although Medicare is by far the big one. So you're just going to have to bite the bullet. I think the Deficit Commission that's supposed to be coming out with their report has a lot of good ideas. I would love to flatten the tax rate and remove all the exemptions and deductions that we put in over the last 20 years. I think there is a movement to do that. If we could do that, I think we will find ourselves in much better fiscal situation.
Okay, so Peter?
Yeah. Well, first of all, if you're not really sure who to believe, Jeremy or myself, one thing that you can do is you can take the one thing that we agree on, and that's emerging markets, Asia, China. Just invest there, and then either way, assuming we're right on that, then you're going to do really well.
Although you suggested also hiring a private militia and building a very large wall around your home. I mean, if the kind of civil
depending on where you live, but yeah, look, people should.
Yeah, but in your case, you'll build an entire wall around Greenwich and Stamford.
But as far as the rest of the world, I agree with Jeremy partially on Europe. I have underweighted the Eurozone. Personally, and for our clients and our funds and our accounts, we have very little exposure to the euro. Our investments in Europe are mainly in Scandinavia, in Switzerland, countries that have their own currencies and are not in the euro. And our investments in Europe are mainly concentrated on German exporters. The same thing in Japan. We are very, very, very underweight Japan. We have some exporters there, but not, the way we are in Asia, it's more domestically focused. But there is a substantial difference between the United States and Japan. There are some similarities in that both governments are making the same mistakes. We are repeating the mistakes of Japan, even as we're saying that, we got to make sure not to do what Japan did. We're doing exactly what Japan did. The problem is Japan made its mistakes from a position of strength. We're making those mistakes from a position of weakness. The reason that these record deficits and cheap money have not resulted in big increases in consumer prices is because, absent all that, consumer prices would be falling in Japan. So you don't really see the effect of inflation, because rather than inflation causing prices to rise, it's preventing them from falling. Why would they fall? Because of the tremendous productivity, manufacturing productivity in that economy, and the high savings rate that they have. And Japan's government is not borrowing money from China. Japan's government is borrowing money from Japanese citizens. Now, that money would have been better if it was invested productively in the Japanese economy. Instead, it's being loaned to the U.S. government. But Japan, while they have a profligate government, doesn't have a profligate population. They have tremendous domestic savings. In addition, Japan has a significant trade surplus. They are selling goods to the world. They are not living beyond their means as individuals. They're living beneath their means. They're also a major creditor nation. We owe Japan $1 trillion, at least in government. So we owe Japan a tremendous amount of money. So we're in worse shape than Japan because we're already the world's biggest debtor. We have to borrow this money from the rest of the world. We have these trade imbalances. So we have far more in common with Argentina than Japan. So if you want to look at, what's going to be the result of what we're doing, look there. Now, yes, is eventually there going to be a problem? Yeah, eventually you're going to see a big spike in interest rates in Japan. Japanese bonds are going to plunge, and that is going to be a problem for Japan. There's no question about that. But we've got a bigger problem here. And I agree, Europe has problems, right? What Europe should have done was let Greece fail, let Greece default. They didn't do it. They bailed them out. And now they got to do the same thing with Ireland. It's a moral hazard. It is undermining the euro. The strength of the euro was that all these countries couldn't print euros, and that would make them fiscally responsible because the bondholders would realize that if they loaned too much money to a country, they might not get paid back because the country couldn't print. That was the strength. What's happening now is the euro is being dollarized. Now the idea is that nobody will default, that the ECB will intervene, that they will do quantitative easing. They will bail out with inflation. But creditors are not going to be fooled forever. Inflation is the same as default. It doesn't matter if I don't get my money back or I get money back that I can't spend because it's lost its value. And so that's what's going to happen. But even though Europe has problems, our problems are worse because they've been growing for a longer period of time. We have bigger imbalances, and we have states that are in as much fiscal trouble as some of those countries. So it's not just insolvency at a federal level, it's insolvency at a state level. And so I do believe that both the euro and the yen will lose value relative to a number of other currencies around the world, mainly in the emerging markets, but also in countries like Australia, Scandinavia, Canada. I still think that both the yen and the euro will rise in value against the U.S. dollar because our troubles are worse. And we are facing a crisis of much greater proportion that is more imminent, I think, than either Japan or Europe.
I'd like to say a couple of things. First of all, you keep on saying we have to borrow from. It's actually China wants to lend to.
Oh, no, they don't.
Oh, they love to.
Believe me, if they could get rid of all their dollars tomorrow and have gold, they would do it.
They love it.
They hate it.
First of all, if you want to look at the model of Asia since World War II, Japan started it. We're going, it's a mercantilist model. We're going to build our economy on exports. Japan, we're going to accumulate dollars. We're going to undervalue the yen. We're going to flood the world with our products, and we're going to build our wealth that way. We'll screw our consumers, which they do. Yes. China decides to look at Japan. Hey, they did it. We're going to do exactly the same thing, and they love to do the same thing.
Yeah, I agree.
They're doing the same thing, and these people say, any minute they're going to get rid of it. I said, well, just a minute. Japan, this is 50 years later. Yeah. Are they getting rid of it?
But look at the trouble that it created for them. You see, they didn't build their economies on... They didn't build their economies on exports. They built their economies on production, on manufacturing. The fact that they chose to export them was a mistake. They could just as easily consume them ourselves. You know, when the Second World War was coming to an end, there were a lot of economists that were urging the government not to shut down the factories, that they had to keep making bombs, that we had to keep making military equipment, because if we stopped doing that, we'd have all this unemployment, right? But what happened was, when we ended the war, what happened? We had an economic boom because factories that used to make weapons started to make sewing machines, washer dryers, you know, products for consumers. China is doing the same thing. They have a wartime economy. But they're not fighting the Nazis. They're fighting to keep Americans spending, right? But all they have to do is stop. If they just simply let the dollar collapse, let their own currency rise, Chinese workers will start buying all the products that their labor and their capital are creating. And instead of us enjoying their fruits of their labor, they'll enjoy the fruits of their own labor. They will benefit. Right now, they could just as easily produce products and dump them in the Pacific Ocean and watch them sink to the ocean floor, and the Chinese government can print up RMB. That's exactly what they're doing by selling products to Americans. It is vendor financing. It's just what happened during the dot-com bubble when you had Cisco and Lucent and Nortel.
But
were
now you're
selling
agreeing
products.
with me. They're lending to us so we can buy their exports.
Yes, but we're not buying because we can never pay it back. It's a waste
Whose
of
problem
resources.
is that?
It's our problem as soon as they figure it out. Yes, right now it's their problem because they're taking
I mean, it's the same thing that Germany did to lend to Greece. Oh, well,
yeah,
lend it to
they're
buy
taking
that.
our monopoly
now
money.
we're only going to get 70
Yeah.
cents on the dollar.
They're taking our monopoly money for their products. But when they figure
I
it
love
out,
it.
the game is
I want
over.
it.
Yes, but when it
wait,
stops, we're done.
But Peter, I mean, so are we saying clearly they've figured it out? But to Jeremy's point, they continue to do it.
But they're not gonna
by
do it
definition,
forever.
They
And
want to
they
buy.
will do it for as long as anyone here is alive.
No, they won't. Look, that's the
Japan
same.
did it, and they kept on doing it, and they
Yeah,
bought over
and look at
US
the mess
stock.
that created for Japan. Look, when I was arguing with people about the housing bubble, the idea was, well, no, that'll never happen. Housing prices will never fall. They will rise forever. Well, saying that the world will loan us money forever, even though we can't pay it back, is just as foolish. It's not going to happen. Bernie Madoff is in jail for a reason, right? Ponzi schemes always come to an end. No matter how long they go, no matter how grandiose, they do not work. And it doesn't matter if it's Ponzi that's operating it or Madoff or the U.S. government. It doesn't work. It always comes to an end.
Oh, okay, but Peter, look, I turn over the floor to Jeremy in the sense that the Japanese, with less than a couple 100 million people during their boom years, had to have an export strategy. The Chinese, with 1.3 billion, actually could stimulate domestic consumption. So, Jeremy, one question is, yes, their per capita income is very, very low right now, but as it rises, does Peter's argument have more merit because domestic consumption starts to become an attractive opportunity as opposed to building only for export?
Well, but that happened in Japan, too. I mean, exactly the same way. I mean, they ended after World War II with, 20% of the per capita income of the United States, and now they grew up to, 90% of the per capita income of the United States. Slowly but surely, they got very well off, continue to be in that. By the way, they're not in surplus anymore. Japan has just about turned into a trade deficit country, interestingly enough. As they get older, I expect them to do it even more because the older people are going to be selling their assets and importing. So I think as countries age, actually, I think they tend to even go more into a kind of a trade deficit. But I think a fundamental thing, you started out, Peter, with this idea, we got to go back to manufacturing.
Of course. If we want to consume, we got to produce.
That's not the way the world is working.
Well, that's why we're in trouble. Our world ain't working right.
It's the same thing in Europe, and it's actually the same thing in Europe and Japan. The percent of their employment that is in manufacturing has dropped precipitously.
And that's why those economies are not doing as well as the nations where they're.
But that's not the new economy. I mean, we know
of course it is.
that. No, it is not. That's the old economy.
So you don't want goods anymore?
Yes, I love them. I love them.
Well, then who's going to make them?
The Chinese,
well, how are we
the
going to
Indians.
pay? But how are we going to pay for them?
They'll love it.
But how are we going to pay for it?
Because they're paying their workers $2 an hour.
How long is that going to last? Look, you have to remember.
Hold on. Are you simply making the argument that you cannot create wealth out of a service economy?
Let me make a quick point. You have to understand that the only reason that you export is to import something else, right? You're trying to maximize your consumption for your people. So it's called, a comparative advantage. One nation produces the things that it can produce efficiently, and so it can export the surplus to import other things that other nations improve. But you don't simply export for the sake of exporting. You don't export so you can have a job. I mean, work without production that's no fun. If you just work but you don't get anything out of it, you have nothing to show for it, I mean, that's like slavery. It's serfdom. When the Chinese figure out that the little pieces of paper that they're holding on to, that we're never going to make anything for them to buy, that there are no products that are going to come the other way, the game is over. They don't want to give us their stuff. They think they're earning real money. They think we're paying them in gold. We're paying them in little pieces of paper. And the game is going to end very, very soon.
No, it isn't. I mean, first of all, you think they're really dumb. I mean, that they're taking...
No, I think they're smart. I don't think they're dumb enough to keep doing it.
I mean,
they did it for a while, you know.
The Japanese did it for a long time and are still doing it.
Look, don't underestimate them.
Why? And the Chinese, where do you want to put them? They're going to put them in Euro bonds now? Where are they going to put their money?
Well, they're going to buy a lot of gold. That's why the price of gold is going up.
3,000, 4,000, 5,000.
Yep, you better believe it. They'll keep buying it all the way up. The only reason the Chinese aren't buying more gold now is they're afraid it'll push the price up. Eventually, they won't care how much they push it up because it's better than holding dollars that are going to collapse. And they're going to invest more. The Chinese aren't going to keep. You know, the Chinese are sitting on almost $3 trillion in reserves. That's $3 trillion that was stolen from Chinese people and to subsidize America. Stop doing that. Allow their own citizens to enjoy the fruits of their labor. I mean, why are the Chinese manufacturing stuff and sending it here? I mean, you think someone in China who's doing their dishes by hand doesn't want a dishwasher? You think someone in China who's washing their clothes in a bucket in the backyard doesn't want the washing machine that they're manufacturing? Of course they do.
You could
just
have
let
said
their currency
exactly
go
the
up.
same thing about Japan 40 years ago, 30 years ago, 20 years. Exactly. I mean, I can repeat it. Why are they taking the pieces of paper of the U.S. and export? Boy,
well, back then they were backed by gold.
Oh my God! Or what are they doing? Oh my God! Oh my God!
Okay, so can I intervene here just for a moment,
story.
which is so one thing, Peter. It seems to me that we've got to give credit to the Jeremy side of the argument here, which is that the U.S. continues to produce companies, whether you call it service, whether you call it software, you call it intellectual property generators. So Google, Facebook, Apple, Amazon.
I mean,
it doesn't matter that Amazon and Apple and Nike offshore every bit of the production of the goods that they have. They are creating enormous wealth in the economy. So
well, there are some innovative American companies, you know, but just relative to the entire GDP, there's just not enough of them. Americans, we have over 300 million people, and most of us are not productive. And that is the problem. Yeah, there are some companies that do well, but we cannot export enough of our information and our services to cover a $50 billion a month trade deficit. That proves that this intellectual or service-based economy is a sham. If we were able to operate a service sector economy and still balance our trade, then I'd have no problem with it. But the fact that we have to borrow $500 billion a year so that we can consume the goods that our economy is incapable of producing shows you that it doesn't work.
Okay, so let me come back to Jeremy. Jeremy's saying we've got a productivity revolution going on here. We've got 6% year-on-year productivity gains. Stocks are trading at 12.7 PE multiples when the long-term average is around 16, 17. So, Jeremy, your point is we actually have a very rosy picture, except for one thing, which is Peter's point, which is what about the $14 trillion debt overhang, not to mention entitlements, not to mention Fannie and Freddie. In other words, does productivity actually dig us out of that hole?
I mean, first of all, you know, the trade deficit is relative also to the position of the dollar. I mean, I would say that if we depreciated the dollar, I'm not saying that that's going to happen, 20%, you know, a lot of our stuff would be very competitive.
What stuff?
Everything.
Well,
I mean, we're still exporting 90%, 70, 85% of what we are importing.
Right, but I mean, as
we're
far
still,
as,
you know,
are our
areas,
televisions going to get more competitive? Are our cell phones?
That's not what we do.
Are our clothing? Is our furniture?
That's not what we do.
I know, but okay. So what is it that's going to get cheaper for foreigners?
What are they buying here? Well, tell us the
aircraft, some chemicals. There's some heavy machines.
Entertainment.
But,
higher education.
They might send more of their kids over here to go to college, but it's not going to close the trade deficit. All that's going to happen on a weaker dollar is our trade deficit is going to go up because it's going to cost us more to buy stuff, and we're going to get less for the stuff we sell.
So the
in order to be more productive, we need lower taxes, we need less regulation, we need smaller government, we need higher savings.
I mean, it seems crazy to me to say, well, we're exporting 85% of what we're importing. Oh, if the dollar goes down 20%, so we become 20% more competitive than anything.
We're not going to be 20% more competitive.
Well, no, that's what happens when it goes down
No.
to the rest
well,
of the
look,
world.
The dollar's been dropping for 40 years. Why is our trade deficit getting worse? Look,
The
the dollar is going down against the Chinese RMB in the last 2 years, but our trade deficit with China keeps growing.
The dollar has lost 0.5% a year for the last 40 years.
That's a lot.
Right.
I mean, look, the dollar in the last 10 years...
I'm talking about...
20%.
I'm talking about from this level. Well, that's only the difference in the rates of inflation.
In the last 10 years,
anyway.
the dollar index was 100 in 2000. It's 80 now. Our trade deficit is much bigger now than it was 10 years ago. I mean, we're getting less competitive, not more competitive.
Well, our trade deficit is less than it was before the crash. Our dollar...
Well, yeah, that's because it was a record high before the crash, but it's still huge.
So if we move away from monetary policy and exchange rates, it seems to me there's a fundamental issue on the table, which is can we actually derive the U.S. economy as a service economy? Already in excess of 85% of GDP output is service sector related. So manufacturing, if it was a game that was important 50 or 100 years ago, we've already given it up.
By the way, the rotation goes on. It goes on, first it was Japan, then it goes on to China. The rotation is partially India, though they have a lot of service and intellectual because of their English and other reasons. Then it goes on to the rest of Asia, and then you have the Middle East, and then you have Africa, where the workers are 30 cents an hour. I mean, I don't know if it's going to catch on or not. There's a lot of debate there. There's also Latin America. This idea, there's going to be manufacturing that keeps on rotating to the cheaper areas of the world. We have lost 60% of our manufacturing jobs from 1975 to the present.
Yeah, and that's a bad thing. It's not a good thing. It's not progress.
Oh, it isn't? We gained 85 million jobs over the same time.
We gained phony jobs. America is broke. Back then when we had all these manufacturing
85
jobs.
million jobs.
Yeah,
per capita income, the highest
yeah,
in the world.
Back then when we had those manufacturing jobs, a man could support his family. His wife didn't have to work. He could have 4 kids. He was saving for retirement. He was self-sufficient. Now, today, with all these phony jobs, a man can't support his family. His woman is working a full-time job. Maybe he's got a second job. They can barely afford to have any kids, and they have nothing saved for retirement. They're counting on a government-led Ponzi scheme in Social Security. We are flat broke. We were the world's wealthiest nation when we manufactured. Now we're the world's biggest debtor. I mean, how can you say that's progress?
Jeremy, you need to respond to this. I'm going to actually, because it may be safer for me, I'm actually going to leave this table, and see if there are comments from the audience. But you need to rebut that. I mean, he's claiming that the Don Draper dream of American life has gone down the tubes. It is shocking.
Peter,
we don't smoke as much.
You sure you're not working for the Democratic Party here?
I ran as a Republican.
This sounds like, oh God,
No, I remember.
The good old days, like Paul Krugman writes about when unions were strong in the 1960s.
I don't want unions. I don't like unions. I don't like government.
That's when the working man, got X dollars an hour and everything was free and medical care was free.
The unions are one of the reasons that we no longer have manufacturing. They help destroy our manufacturing base along with government.
You're right.
We found common ground.
Yeah,
I love it. So we got BRIC countries and we're anti-union. That sounds tremendous. Any other things you guys want to agree on? I mean, you're wearing same color suits.
Give it to the audience.
White shirt. So do we have questions and comments from the audience? Because clearly the world is ending, and clearly we have got the greatest productivity boom facing us that we've ever seen.
Just America.
So we've reached absolute consensus. Sir, will you let us know your name and affiliation?
I don't think it's working.
Can we? Oh, I'm sorry. We'll just turn on. It always helps to turn on the power. That's my fault.
Carl from Sweden. Question regarding manufacturing, how important that is. Some of the countries in the world with the highest GDP per capita, Luxembourg, Norway, maybe Singapore, they don't have much manufacturing. How can that be?
Right. But I have quite a bit of money invested in Norway. I mean, Norway does not, Norway is a major exporter of raw materials, of energy. So their books are balanced. I mean, Switzerland, I have a lot of money invested in Switzerland, and Switzerland doesn't have a lot of manufacturing, but they don't have a trade deficit. They're able to provide other things to pay for the manufactured goods. So you don't have to manufacture if you have a way of paying for the products that you import. The problem is America does not. We cannot pay for all these products. That's why we're running a $50 billion a month trade deficit. So, yeah, if you can find a way to give the Chinese something of value in exchange for the products that they make, that's fine. That's great because that works for the Chinese. But if you have to borrow the money from China to buy their products without any ability to ever repay it, that doesn't work.
Jeremy?
Let me repeat the fact, as if the Chinese want to take our dollars in exchange for what they sell it.
Why?
They want us. They do.
Well, they're just pieces of paper.
They love it. They want it.
What are they going to do with it? It's not soft enough to use as
go
toilet
over
paper.
there and do some consulting for them. But this is, that's the craziest question I've ever heard. They want to take the dollars.
So they can what? So they can put them on the wall and stare at them? Oh, these are my pretty
Well,
dollars.
Wait, but Peter,
well,
they didn't
when
wanna
we
take
get
them?
to use their washing machines and and watch their plasma TVs, all they get is a little dollar in a frame, and they stare at it.
But in fairness to Jeremy, they continue to buy them.
They love them. They continue to buy them. Absolutely.
Well, I don't love them.
Voluntarily.
All right, let's take another question from the audience. Let me see if I can navigate my way down here. We'll involve a little furniture moving and all the rest of it. So, Rick from Equation Consulting.
The question Jeremy asked that Jeffrey asked to Jeremy, how will productivity dig us out of this hole? Talk about how productivity will do that.
Well, okay, well, if you go back, I'll say, just to give you a sweep, 100, 150 years ago, man had to work almost all the hours for food and basic shelter, basically survival. Now in advanced countries, an average person has to work from 15 to 30 minutes a day for survival. Everything else, that's true. Everything else is all discretionary. The world economy is discretionary. So what happens is the more productivity is, the less all the time you need to work for all the basics, the more you have discretionary income to buy, HD TVs and anything else that you want to buy. That is what's driven the economy over the last 100 years. That's exactly what progress is. That's exactly how countries raise their standard of living. Because productivity means you get more output per hour worked. It gives you income. That income gets spent on discretionary goods. Again, the 95% of the goods that people buy, and that provides the employment and the economic growth. That is the story of the last 200 years.
Peter?
In the developed countries in the world.
Quick rebuttal?
Yeah, you're absolutely right, and that is what grows the economy, productivity. Unfortunately, American productivity, at least in the last 10 or 20 years, is a complete myth. It was created by government statisticians. The productivity that we're living off of is happening outside the United States. It's Chinese productivity that is improving our lives. It's the reason that we don't have to work that hard to have food or energy. But what's going to happen when the dollar does collapse? Food prices and energy prices are going to go through the roof. And Americans are going to be working almost entirely for food and energy. And what they don't spend on food and energy is going to go for taxes or insurance or things like that. Our discretionary spending is going to collapse. We import 90% of our seafood. 90%. We're surrounded by oceans. We have all these lakes, yet we import all of our fish. Can you imagine what's going to happen when the dollar collapses and we can't import all the seafood? Prices are just going to go up, and we haven't. We need productivity, but we're not productive. If we were so much more productive, where are all the products? Why aren't they on the shelves at Walmart? Why can't I buy them? Why don't I have them? How don't I have all these products in our house? If we are increasing our productivity, where are the trade surpluses? Right? They're not there. Reality doesn't back up these productivity numbers. They're created using hedonics, using all kinds of gimmicks and tricks. The government calculates statistics, whether it's GDP, whether it's productivity, whether it's inflation. They're all reverse engineered. They're all designed just the way the old, Soviet Union or the Nazis. Propaganda is really what it is. It's to paint a false picture of a prosperous American economy when the reality is the reverse.
Oh, my God. All right, so you cut through the propaganda. The message from the U.S. government is let them eat steak. Because I'm shocked about the idea that fish could go away. Sir.
Hi, I'm Steve from Princeton. And I had a question, I think directed mainly toward Peter. I think I understand that your view is manufacturing goods, service sector bad. But I was wondering how you view the information economy, whether you give credence to that. And I guess in my personal view, if you look at really emblematic companies that are creating things that people want to consume in the information economy, you think of Google, Twitter, Facebook, Amazon. And I'm just wondering whether you're optimistic at all about that, or whether you think it's bogus. Or
I mean, whether I'm optimistic on what the companies are doing or the share prices, I'm certainly, a lot of these stocks that you're talking about trade at extremely high multiples, which price in a lot of success that may or may not be achieved. You never know. Think about what people thought about Yahoo not too long ago when no one even knew about Google. So is there something that's going to happen in 2 or 3 years that's going to knock Google off its pedestal? I have no idea what's going to happen. So I don't like buying these stocks that everybody likes and everybody are so sure are going to be so successful, because you pay through the nose to own those companies. So as an investor, I'd rather find companies that are out of favor, that are low price, that have good yields, where you're more likely to be surprised to the upside because good things happen that people don't expect, than to the downside where bad things happen that people don't expect. But that doesn't mean I discount the quality. I use Google every day. Google certainly impacts my life. It improves my life. And I'm not saying we don't want companies like that. My problem is, collectively as a whole, there aren't enough Googles to close the gap of the trade deficit. We still have a $50 billion a month gap between what we consume and what we produce. And what we produce includes information, it includes services, but it's just not working. We have to balance those books. You can't borrow money forever, because that means that people will lend money forever without ever getting paid back. And I don't know about you, I don't want to do that. When I loan somebody money, I want it back. And if I don't think I'm going to get it back, I ain't going to loan it anymore.
Peter, we have another question from the audience, but Jeremy, I want to give you a chance to respond to two things. One is the comments Peter just made about where wealth is actually created. The other is the comment, Peter, you made a few minutes ago, which is that the productivity revolution, the 6% year on year, is largely because we're offshoring or outsourcing much of what we do in the U.S. economy and producing it through offshore or rest of world economic activity.
Well, some of it is. That's always been the case. But, going back, well, I agree that a lot of these technology issues tend to get way overpriced. And I always very leery about that investment area. But, when you look at the technology revolution of what has happened, communications and technology, it was almost exclusively in the United States. From Microsoft to Google to Facebook to you go on and on and on. In Intel in the United States. For instance, Microsoft revolutionized my research. I could not have written my books without a word processor. It was just very difficult for me to do the type of editing. All of a sudden, I found an ability to do things and that process information, et cetera, that I never had before. None of my research would have been possible without it. I can thank Bill Gates a million times over. That was born and developed in the United States, which was so critically important to me. Now the standard around the world. Made in the U.S., now the standard around the world. On and on and on. And by the way, you always have to look about debt relative to the size of the economy. So in terms of, and I do agree, things are growing faster than that. They're going to have to stop at some point. And I will agree our deficit's growing faster than the economy now. A number of things are growing faster than the economy. But one has to realize that as the world economy gets bigger and bigger, just like a successful corporation, it's going to have more and more debt on its balance sheet. It'll have more equity. It'll have more assets. It'll have more everything. The question is getting things in line. It's not just the absolute size of the deficit. And we still export 85% of what we import. That gap is what? 4% of the GDP as now calculated here. It's not something that's going to cause if we get balance there, of course, it's not suddenly going to cause a total collapse of either the currency or our economy one way or the other.
What you have to look at, Jeremy, you can't look at everything in a static world. When I was arguing with people about the housing market, and they would tell me, you have to look at mortgage debt as a percentage of home equity, that it's not a big deal because look how much houses are worth, and the mortgage debt is small relative to the total value of houses, and the cost of servicing the debt is still low. And my point was always, that's today. What happens tomorrow when interest rates rise, and so the cost of servicing the mortgages go up, and housing prices come down. So everything changes. So you can look at our debt to GDP and say, hey, the debt is still manageable relative to GDP, even though it's actually pretty high, But what happens if GDP contracts significantly and the debt goes up? And more importantly, not only does the debt go up, but the cost of servicing the debt goes up. So now the interest payments are much higher relative to that GDP. And of course, if people start to get nervous about our solvency and inflation, it's not just paying the interest on the national debt that becomes a problem, but repaying the principal, because people don't want to roll over their securities. One of the things you have to understand about countries like China, over the past several years, China has dramatically shortened its maturity, so that almost all the U.S. debt that China holds is bills, not bonds. So China has put itself into a situation where it's very easy to get out of U.S. government debt because it doesn't need a buyer. It just lets it mature. All China has to do is not buy new debt, and it's out of dollars in a very short period of time. And so the world is getting into that situation. So you can't look at the way it is now. You got to extrapolate on what it might look like a couple of years from now with a lower GDP and a much higher level of interest rates to see how quickly insolvent we become. And also, it's not just the trade deficit, but it's the current account, because you have to realize that a lot of the interest payments that we make are to foreigners. And so as interest rates go up, the current account deficit can rise, even if the trade deficit is contracting, because it's costing us more to service all that debt.
Okay, gentlemen, we have another question. Gerard from the audience, please.
My name is Gerard de Brunet from Algo in France. Yes, just a few comments and questions. First, I don't know how economies behave, maybe more about human beings. I'll come to that in a minute. But Peter, I don't really understand your point about the manufacturing sector, because I'm sure you will agree that there is no way the U.S. economy, or could say the same about Europe, could come back to a manufacturing sector weighing, I don't know, 20%, 25, 30% of the overall economy. So it just will not happen.
Well, that I disagree with.
You'll have a chance to answer. I promise.
Yeah.
I'll have a chance to answer.
Oh, I thought that was your question.
Although Gerard, the time is growing short, so you may have the last word.
Yeah, I know. You're Frenchman.
This is working very well.
Interrupt people and so on, but okay. I learned a lot this morning. No, and this has to do with about the question of comparative advantage of nations and so on. I don't want to develop it unless the American people are ready to lower very much their standard of living. There is no way. U.S. economy will turn back to manufacturing as the level that you imagine. But one of the points which I wanted, in fact, to comment on, you don't talk too much about the behavior of consumers. And to me, that's more important, which is, you mentioned the fact that people want to have goods. Yes, but they realize, especially in difficult times, that when you have a car, you may have a car a bit cheaper, or you may prolong it for 2 years more, and it still will give you the service that you want. And people are discovering that all over the developed country. And when you can buy a suit at the opening season in September in Europe, and probably the same here, or you can wait 3 months and get it the same suit for 40% less. Personally, that is what I do for the past few years. I mean, I don't see why I should pay 40% more just to have it 3 months before, and so on. And I think that what is happening now in this crisis, I don't know if it's new, I don't have a historic perspective of that, but I think that there are some profound shifts in consumer behavior. You probably know the story of the Dacia that Renault manufacturing in Europe. Originally it was manufactured in Romania, and the Dacia was devoted usually for the eastern countries. Yeah. And then the crisis happened, and Renault is selling the Dacia all over the wealthy, so-called developed countries in Europe. So, and probably this is something which is at the heart of what is happening. Yeah. There are strong changes in individual behavior of people.
I get an answer.
And also, I'm sorry, just to complete, and it's true that they want more service, because when you realize that all of the goods you have, what do you do? I mean, you can have a second TV set, you can eventually have a third TV set, but you cannot have a fourth. That's silly. So you're looking for something a bit more sophisticated, usually that's what comes with services.
Okay, we will, Peter, we're going to have a 1 minute from you and 1 minute from Jeremy.
I got it.
We're out of
First
time.
of all, Okay, first of all, absolutely think the U.S. can go back to manufacturing. We have 16% of our population basically unemployed. They can be employed in factories. But yes, wages are going to have to fall in this country. We have to abolish the minimum wage law. Our standard of living has to come down. There's no way around it. We have to allow people to be employed. We have to stop these unemployment benefits that extend indefinitely so people will take lower paying jobs. We also have to, on the consumer side, why are consumers spending so much? Because government subsidizes their borrowing. Governments are enabling the government is buying all the car loans. The government owns the big car financing companies now. They subsidize credit from banks for credit cards. If we had much higher interest rates, if we didn't have all this consumer credit that was a function of cheap money, Americans would be saving instead of spending, which is exactly what we need them to do. And, you know, when we were the world's biggest manufacturer in 1950s, let's say, we also paid the highest wages in the world. There are other countries, like Germany and Japan, where the wages are higher than they are here, and they have trade surpluses with China. So it's not about low wages. Unfortunately, wages in America have to fall now because we no longer have the capital that we used to. But if we can become an industrial nation again with low taxes, if we can have savings, if we can repeal all these government regulations that make us uncompetitive, eventually we can have higher wages and manufacture. But yes, right now, given all the government, all the regulation, and our lack of capital, the thing that has to give is wages. They have to fall. There is no way around it. They will fall one way or another. Either they'll fall in real terms or they will fall because of inflation, because the Fed will create so much money that our wages will collapse as a result.
Peter, thank you. So, Jeremy, final word to you.
Final word. See a lot of students, many more from China, India, developing countries. Basically what they tell me is, Professor Siegel, we want to come to the United States. Higher education is absolutely the best here without question. We want to get our ideas here. We often state we have ideas. We want to get the ideas here for new products, generate them. Once we have them, we want to finance them, float them, all the rest. We will produce them in our own country, though. And that's it. They say, you know, you just can't be competitive here. But you know what? What percent of the final price is that production price? It's not that big. It's not that big. So how much of the gain all comes from the synergies that they get from being in the United States with the people who think this way, Silicon Valley versus the higher education versus, you know, where they want to do in finance and how they want to float it and how they want to structure it and all the rest. They still come here to do that. And that is a vital part of what I think is the comparative advantage of the United States. We need to maintain that comparative advantage and keep ourselves open to the rest of the world.
Jeremy, thank you so much. I have to say, I don't think that we could have put a table together here with a better bull or a better bear. And my God, did the bulls and bears go to war. Thank you so much, gentlemen. Thank you so much.